welcome back to another week of our market updates. Today is June 9th, 2023. This is Kelly coming to you with another week full of economic news. So let's just jump right into it. Overall, this week was generally quiet as investors are really just awaiting the key CPI and PPI reports out next week, right before the Fed decides on another rate hike on next Wednesday. So, markets moved up slightly positive this week. Dow Jones leading up about 0.8% as of Thursday, S&P up about 0.5%, and the NASDAQ just about flat. So not a super crazy week of economic data, but we did see some market movements here. One thing I did want to note as of this week, as of Thursday close, the S&P 500 is officially in a bull market. So here you can see just from the October 12th lows right around here, from that we are up just over 20%, and it may even be more by the end of Friday here. So definitely a bull market in the S&P 500. Doesn't mean a whole lot, but we are definitely approaching a key turning point in terms of if the markets are going to continue appreciating or if we're going to see some economic downturns and some struggling markets in that situation. Also, in a pretty strong bull market, and has been for a little bit now, the NASDAQ is up about 30% from its lows in late December. I think around December 28th here is when it hit its lows, and now you can see it's up almost 30% as of June 8th. So definitely a tearing bull market in the NASDAQ as well. And we want to just keep an eye on these. I think we're in a pivotal point now if the equity markets are going to continue to rally or if they will suffer a little bit with some weaker economic data coming out. Another trend we've been keeping our eye on here is the growth versus value. So here you can see in 2023 so far, the Russell 1000 growth stock index is up almost 23% on the year as of Thursday, June 8th, while the value index is up barely just a percent and a half. So very different story than 2022, where we saw value stocks hold up pretty well while growth stocks just took a huge beating. And I think the largest reason for this is interest rates, right? So interest rates are settling towards a plateau. Markets are pricing in a rate cut by the first half of 2024. And this impacts the valuations of growth companies because their future earnings are discounted at a market rate. And as that rate settles, valuations look a lot better. So I guess that's one explanation for this. Also, growth stocks took a huge beating last year, and maybe investors are realizing that, maybe they actually are worth a bit more than what they were at those lows, where the lows of the NASDAQ, again, were just in the end of December. So definitely taking a look at these trends as we continue to monitor and observe the markets. Shifting gears a little bit here to some economic data of the week, we got the ISM Services Index for the month of May coming out at 50.3%, which is just about a neutral reading on that index. The expectations were a little bit higher than that at about 52%, and so that miss is definitely more of a bearish trend in the ISM Services Index and the services industry as a whole. So we already saw the manufacturing index take a bit of a hit over the last recent months, and the ISM Services Index is starting that trend. So important things to know and to be monitoring as we situate portfolios and just, stay on top of the markets and how the economy is doing. This week, the Fed reported April's consumer credit data, where credit grew at an annual rate of 5.7%, the same rate as in March. And we saw growth really be driven by a larger increase in revolving credit, which is made up of credit card debt largely, and that grew at a faster pace of 13.1% from a year ago. On the other hand, we saw non-revolving credit, which is things like car loans, student loans. They grew at a much slower pace at an annual rate of about 3.2%. And so from this data, it seems that consumers are relying more and more on those short-term liquidity sources, such as credit cards, to fill in the gaps in their budget, as opposed to taking out credit for those larger ticket items like cars, student loans, or other larger items. So definitely an interesting thing that shows a lot about the consumer here. Thursday morning, the BLS reported the initial claims data for the week ending June 3rd, where claims rose by 28,000 in just 1 week to reach 261,000, which marked the highest level since October of 2021 right there. So definitely a huge uptick in the amount of initial claims, and that also followed the sentiment of the higher unemployment rate in May. So that pulled the 4-week moving average up to 237,000. Definitely a trending move upward over here since about February or January-ish. So definitely an uptick in unemployment, uptick in initial claims data, but again, nowhere near the levels of a recession. So just want to put this in perspective. This amount, even under 300,000, is still quite low for a period of time where we're about to go into a recession, most likely. One final thing I wanted to take a look at, as the Fed meeting is just a few days away here, the probability for no rate hike is still winning out, up to about 72%, and it has been in the 70s over the last week or two. So definitely pointing to no rate hike next week, but I think the more interesting thing is when we look forward to July, and I will pull that up in the next screen here. Yeah, so a lot of mixed results when we're looking at the probabilities of what the market is pricing in for a July rate hike or not. Here you can see, a third are pricing in no rate hike in June or July, and about half are pricing in one rate hike in either of the two meetings, and then another small chance here that there is 2 more rate hikes. So definitely a lot of volatility, and this is constantly changing every single day, every single hour. This is as of the morning, Friday morning here, June 9th. And so that's obviously subject to change a lot in the next few hours, days, whatever, as we get more economic data. Specifically, what we're looking out for is that inflation print, the CPI print early next week, right before the Fed meeting. So lots of things going on here, lots of volatility, and we look forward to seeing the Fed meeting next week for sure. That concludes our market update of the week. We appreciate you tuning in, and we look forward to providing another update just next week, especially with the Fed meeting. So thank you, and we will see you next week.